Well, it's a real pleasure to be here. I wish I could be there in person, but due to travel constraints, this was the best way to join you all. So my name is Alex Silver, as Marty said. I wear two different hats generally in life, like or maybe multiple, including being a parent. But one on the business side is I've been involved in the principal investment side for a period of time. It's relevant to what I'm about to share. My entire career, I started at Lazard, then was at the Soros organization and the private equity group. Went to business school at Harvard and have been in the hedge fund / private equity world ever since. Most recently as a partner at a firm called P2 Capital Partners, which does small cap investing, active engagement in private equity. And I'm launching a new firm in the first half of this year. And the reason I share that all with you is really the story that I want to share a little bit about is my experience having a child born with a rare disease, starting a foundation that we then grew to the largest global one, and then really putting venture philanthropy, as it's now called, front and center from a perspective of actually driving results, and to just offer a little bit of view on what I think the role it can play, should play, and at least 2 cents based on my experience and my conversations with Marty. So my oldest child, who's now 16, was born with a condition called recessive dystrophic epidermolysis bullosa. For those of you who are familiar with EB or epidermolysis bullosa, it is a condition in which you're missing the proteins that bind your skin together. So the way to think about that is those who do not have this protein, their skin literally sits on top of each other. So friction is the enemy. And my son was born in a pretty severe subset called recessive dystrophic. It's a recessive inherited condition. And it's a really, really tough go. It's very hard when you live in the rare disease world. Nobody likes to get into the comparison game. But one thing to think about is skin is your largest organ. It's your first line of defense. So anything you do in life is impacted, whether it's sleeping, moving, walking, hugging. And this condition is truly progressive and then exponential in its form that once you have extreme skin fragility, when the skin is damaged, it either comes off, sloughs off, blisters form, and then there's meaningful scarring over time. Almost think of becoming a pretty extreme burn victim. And then there's a impact to lifespan through squamous cell carcinoma. Same protein affects your eyes, your esophagus, your GI tract. So it's really a tough go. When my son was born, there were very few clinical trials, and we started a foundation. That foundation is now called the EB Research Partnership. We started, it was called the Jackson Gabriel Silver Foundation, and it was started at our kitchen table. And the story of it, and I'll give you the abridged one, is that we did like many other rare diseases, started out by, friends and family. I'm in New York City, New York-based finance and legal network, and then rapidly expanded that through inorganic. We acquired several organizations as well as organic growth, and really became the largest organization in the world funding EB therapies, including the proceeds from venture philanthropy. When I chaired it, it was north of $50 to $60 million raised, and pretty much every clinical trial that you can point to, for the most part, including the first drug that was just approved by the FDA, was funded through our venture philanthropy model. And the reason I bring that up is less about claiming credit, but just to talk about what venture philanthropy does and what the real value is it from the perspective of being both a parent, but also somebody who does capital allocation and investing for a living. So if you think about, let me take a step back. The key for venture philanthropy, when people think about it, is they often think about the idea that you can compound your capital, and that this is an idea that you simply are able to go into take these risks be the risk capital that moves things through the spectrum across the chasm, whatever terminology you like. And in return, you have a series of call options, and those series of call options may or may not pay off. But ultimately, you're funding this research anyway, so you might as well take the call options. And that helps you raise capital. The most important thing that comes from venture philanthropy, though, is the idea that you're able to exert control over the intellectual property, which becomes very important when things get stranded. But more importantly, you take the commercial mindset much earlier into the drug development process, which means if you look and measure those who live with rare diseases often have shortened lifespans. If you can collapse the time to success or failure by half, You've literally gifted life back to an individual by failing or succeeding quickly and bringing forward those elements that mean for commercial success. This model, just so you know, was not born out of a stroke of genius before we called it venture philanthropy. It was actually born out of a mistake. I believe you're going to hear from Mark D'Souza, who's truly an amazing individual, and his business Sense, and a business we also created together called Phoenicius. And what happened way back when is the first project we ever funded when I created the foundation was a project at USC that did intravenous protein therapy. So in EB, you're missing a protein, this replaced the protein. Mark, and working with Mark, we were able to get funding from Third Rock Ventures, and it became the first successful exit to Shire in the rare disease market, or sorry, in the EB market, period. And then what happened was nothing short of a tragedy. There was turnover at Shire, and this program got orphaned for 5 years. And the reason I bring that up, through Mark's help, we were then able to lift this program out, which is now with Bridge Bio, and we believe there's a path forward, which I can get to in the future. But what was really interesting is I sat there as a foundation leader at that point in time and said, wait, this makes no sense. We put up the capital. Third Rock was able to make money from them, which is this job. And now Shire's sitting on this, so we are no better off as a foundation. We have no more resources. And now this intellectual property we paid for is stuck in a large entity, and there's nothing we can do about it. And I just swore that would never happen again. So the way we went about it is first with our academic partners, we created agreements in which there were revenue shares based on royalties. From that, we also then had intellectual property rights, anywhere from positive to negative restrictions and covenants. And the evolution of that led to funding both public companies. So if you look at Crystal Biotech, we took restricted stock in that at $11. This is all public. The company did a reverse merger at $10. Without our capital, it wouldn't be the $3.5 billion company it is today. We funded the work behind Abeona and took stock in that. We worked with ProQR, which was a public company, got a guaranteed ROI. But the general idea was marrying the principal investment process, which is, we get to participate in the upside. By the way, totally agnostic to the path of least resistance. In a private company, if they're doing a Series A, join the Series A. If somebody wants debt with warrants, debt with warrants. Really, at the end of the day, you just want to participate in the upside, and then make sure that if something happens to the intellectual property, you have a say of what can happen so it doesn't get stranded. So we did this with public companies, we did it with private companies, and then at the foundation, we started creating companies. With the foundation, EB Research Partnership being the principal shareholder or putting up the capital to take the risk. We created several companies actually with Mark D'Souza, Deb Ramsdale, who you hear from at Phoenicius, and Hal Landy. And those companies all were specific EB projects. And then ultimately, we decided to put a number of those companies together to create Phoenicius Therapeutics, in which you had then risk capital from the foundations translating into meaningful equity ownership. And you had the idea of a true great commercial-oriented development team, bringing this intellectual property through the phases from not just idea, but to a patient. I will tell you first and foremost, as a father of a child with EB, and I say this respectfully, if you prove something in a lab that lives in an animal but cannot be replicable and change the quality of life, that is not of much value to somebody who actually lives with a rare disease. You need to have a path and thought process towards commercially sustainable solutions. And that's a very different incentive than traditionally you find in academic solutions. So by using this model, you're reaching back earlier into the process, then creating this opportunity to take commercial incentives such that it's in the patient's interest, creating commercial upside and de-risking early stage intellectual process. The other thing people often forget is you bring the organization, meaning the community, to this. People who see from an outside rare disease community think, oh, if we create this, someone will come. Having now been on the clinical trial side, it's super hard with people who have complicated lives to get them to disrupt their lives and come to participate in your trials, even if it helps them. You need to have those relationships, so you bring the community back into this. And I don't say any of this from a soapbox or any grand idea. Again, this was born out of mistake, but I will say it from a series of successes we've had over the course of almost 12 years now, which go from funding Crystal to funding Abeona to funding a company called FiberCell to pretty much any late stage commercial stage therapy you can see. And EB is now related to this model. I personally stepped back from the foundation about a year and a half ago and really focused on Phoenicius Therapeutics, which I chair. And as you move more towards commercially staged ventures, you need larger quantum than you typically have found in the nonprofit world. But that doesn't mean these aren't good investments. And I think this is the part where Norm Friedland really speaks very eloquently about this. I couldn't agree more, Mark and Marty, that if you actually take a step back, these are actually really good investments at this point in time. So whether you look at Dollicents or Phoenicius, you're typically looking at companies. So forget that these are rare disease companies where you have enormous quantums of capital that have gone in before them. In the terms of Phoenicius, which has these EB therapies, including Decarin and other ones that we may bring into it, and a gene editing one, you have the benefit sometimes of north of $100 million of funding, in which the incremental funding, so some of the things we're looking at within Phoenicius, for example, take at most 15 to 20 million more. So if you look at the aggregate capital in which you're standing on and the incremental return, and then you look at the cost of care of something like EB, I've shared this before, the EOBs for my son were north of $1 million alone last year for insurance companies. There's a reason these drugs, when priced, even at several $100,000, are actually accretive to the healthcare complex and better to the quality of life. Not to mention, you create vouchers and other things of that nature, which have tremendous commercial value. So at the end of the day, when I look at these things and say, okay, I've looked at businesses where you're typically the incremental capital, and the question is, what are you de-risking and what is the return from that? And typically when you have these people like Mark or Norm and myself, we want a win-win situation where the capital providers in the community are working, so they're priced in a way that the risk reward is incredibly attractive and belong in any portfolio. And I'd actually argue they're probably better as a series of portfolios with people who know these diseases really well, especially have funded the clinical trials and have brought the know-how to do it, that you're not just giving money away for the sake of it. You know, you could do that through a charity. You're actually making an investment. That investment has a reasonable, maybe it's a lottery ticket type one, but a very high payoff if it works, but it's an intelligently thought through one that is the culmination of a project that starts in the nonprofit and academic world and accelerates through the commercial world into the venture philanthropy. By doing some type of mission-oriented investing, though, you ensure that it serves the purpose of which it was intended, as well as enable it to grow to a much wider and larger audience, which you often see with these rare disease.
Alex, this is great. So I think we've got about a minute or two. Does anybody have any questions here? Yes, one question from Rob Collarina. Rob?
How do you measure return?
How do you measure return?
Great question. So you can measure, so there are a couple ways to do this. In a company like Phoenicius, you measure return or Sonalisence the same way you'd measure return in general in a commercial-oriented aspect. If you are thinking of both mission and return, my suggestion is the following. You just have to have very, very clear definitions, because my experience has shown mission comes first until there's a near-term exit. So the question is, if you go on agreeing that there is a threshold at which, you know, the financial return trumps the mission. And the question is ultimately what matters. For me, I'm long-term greedy. I would say most of these things when developed to fruition will create multiples as opposed to a quick term aspect. So I think mission should support return and be effectively in parallel and to a certain threshold is the way I would suggest.